right, how about Wells Fargo, which gave you the worst quarter yesterday, but paradoxically had the best performing stock, up more than 5%. Even so, when I say worst, they still delivered a 35-cent earnings beat on a 70-cent basis, with higher than expected sales up 2% versus last year. When you drill down here, though, these results were far from perfect. Now, Wells had some truly ugly average loan numbers, down 8% in consumer banking, down 19% in commercial banking, even down 5% in corporate investment banking. Remember, what we saw with JPMorgan, the investment banking business was fabulous, but traditional banking was a lot less impressive. Well, Wells Fargo is predominantly an old-fashioned consumer bank, and a worse one than JPMorgan. The addition of a big chunk of that earnings beat came from a release of $1.6 billion in reserves. That's what these companies can do because things are better. And they no longer needed them to cover loan losses. Again, that's a one-off. And on top of that, their expenses really remain stubbornly high. I'm very surprised. But Wells Fargo stock roared yesterday because this is viewed as more of a turnaround story than a banking story, which is why we actually own it for my Chapel Trust, which you can follow along by joining the ActionAlertsPlus.com club. Now, I keep telling you it's a better buy than JPMorgan because the expectations are much lower for Wells. And yesterday, they absolutely cleared that low bar. 18 months ago, Charlie Scharf, a banking veteran, tough guy, took over as CEO, and he is doing everything in his power to right the ship. He doesn't need to deliver perfect numbers yet. He just needs to show his investors that he's making progress. And that's exactly what he did.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.